I'm Charlotte McLeod with investingnews.com, and here today with me is Joe Mazumdar, editor of Exploration Insights. Thank you so much for being here. Great to have you.
Thank you very much for inviting me.
Yeah, it's really good to be catching up. I think we last spoke in the summer of 2023, so it's been a little while. And 2023 was kind of a tough year for many of the juniors. So I wanted to start there with just a little bit of a look back and talk about what trends you saw, who was seeing success and who was not in terms of types of companies.
Yeah, I mean, intersections, like still high, very high, a couple of standard deviations better than the peer average. Those intersections still move the market. Like the Hercules Silver intersection that ended up getting a private placement by Barrick near the end of last year. Work done by Southern Cross Gold, ASX listed company that I visited recently in Victoria. So there are moments that spark the market. But the issue and the sentiment, it's a weird sort of environment, especially for gold, where the gold price is doing fairly well, continues to do very well, but the equities are not. And there's that dichotomy as where's the leverage? And that leverage has died in the latter part of last year. And what I've seen is that some of that leverage died because people's costs have gone up. And so the producers are having a harder time showing margin leverage because it's actually gone down, their margin's not up. And then also they can't show reserve growth because of higher costs. So people are looking at, gold price is doing fine. Why aren't you doing great? And those are some of the reasons. But now people are going, is everything very highly undervalued? So I think this is a good moment to review the gold sector, find those quality plays, and start accumulating because, the gold price is there. And then last year we had a lot of central bank buying, even though the real interest rates were going up, gold was still going up because it was central bank buying, and they don't buy equities. So that would never spill over into equities. So that's part of the reason that we didn't see the leverage, but I can see that changing.
Right. And I think the follow-up after explaining the why of why we have that disconnect between gold price and gold stocks is going to start changing. Any further thoughts on when or what might cause that to change?
Well, absolutely. For me, in the junior sector, more M&A would help. And so we've seen M&A, small M&A, but now recently, Asino Resources is open pit, not huge, high grade, like 1 gram-ish open pit grade in Namibia. I think it was 2 million plus ounces of reserves, maybe over 3 million in global resource. It got a positive bid from Dundee Precious Metals, which was a premium, which was all good. Half cash, I think, half shares, which is also good. But then last week, or the week before, last week, they got an extra bid, a competing bid that was even higher, and it was all cash. So when we start seeing multiple bids, all cash, that's a good sign. And then people will start thinking, and this was a development play, because they had reserves that retail doesn't like. They want the grass, they want the exploration stuff, they don't want development. So it's nice to see, and I think in this market, the development guys have been hit even harder. So if you can find a quality development play now, in a good jurisdiction that can get funded, this is a good environment that they could get taken out.
Okay. So opportunities in gold stocks right now, time for people to maybe think about positioning. I want to talk about your presentation here at PDAC as well. I didn't get a chance to see it, unfortunately. I got stuck here at this stage. But, the title, Why the Nickel Market Sucks. So we have to go into that based on the title alone. So why does nickel suck right now?
Well, nickel was down about 45% last year. It was next to lithium carbonate equivalent in the commodities, ETFs, and other asset classes I cover on a weekly basis in the letter. That was the second worst performing asset. And so I own one nickel play, and then I started digging into it more to find out, well, what's going on here. And as I dug into it, then I'm finding that even though nickel is a critical mineral, we need it for the EV batteries, and the more nickel you have, the denser the battery, and makes the battery, it increases the longevity. You could drive farther, and it could hold more power. So nickel's a great thing. And what we were buying into before was a difference between class 1 nickel and class 2 nickel. Like, these will not, you need this one. But the investment in Indonesian nickel production, which was about $30 billion of announced potential investments downstream and upstream, that's flooded the market with nickel. And this nickel is going, even though it might be laterite, it's going straight into Chinese batteries, and that's basically flooding the market. And also what we're seeing is China making less of the nickel batteries, the NMCs, and now they're looking more at what they call the LFPs, the lithium iron phosphate batteries. And so there's less demand from China. And so you've got surplus coming from destocking from China as well, that's layered onto overproduction from Indonesia. But on a positive side, is, at current market prices, 35% of nickel production right now doesn't make any money. If you drop that price down maybe another buck, like almost 70% doesn't make any money. So these are drastic prices that we're getting to. And so we're seeing the production cuts. So we probably need to see those production cuts hit the market for us to get that overhang on the surplus down, and then potentially we can then see, production coming back up.
Okay, this is really interesting to me. So I have a couple of follow-up questions. So I was reading all these articles that were coming out the past couple of weeks about all this Indonesian supply, and then large miners who are having to make cuts, and they're very perturbed by all what's going on. And one thing that was mentioned is, they produce a greener product, but people are not willing to pay up for that, which is interesting from an ESG standpoint. So I'm wondering your thoughts there.
Yeah, well, that's the thing, is that, you can go in and say, hey, we're doing this and this. It's a little bit more costly. But it'll get you a green nickel commodity. But the problem is that people don't care. Because, if you're a purchase manager and you're building a car, if you can get something for $1, you're not going to pay $1.25 for it, because you want to keep your job. So that premium doesn't exist. They want it, but at the same price. And then the other potential issue right now that could help the nickel market is apparently permitting in Indonesia is getting harder. That could slow down production there. And the other thing is, if people start taking seriously the IRA subsidies for electric vehicles and components, because the big thing is Indonesia, I'm pointing back here, is Indonesia does not have a free trade agreement with the U.S., and the Senate stopped that from happening. So if they do not have a free trade agreement, then you do not get that subsidy if you have an EV battery built in a car that goes to the States. And you need it to be competitive in the States. So then where do you get the nickel from? Because everywhere else is not producing at that kind of level. So do these other projects start getting looked at or built?
Okay, very interesting. And one more point on Indonesia, because, we've been hearing more about supply chain security, especially for these battery metals in North America and Europe and things like that, and worrying about, can we accomplish that? And it seems like we've seen this really impressive ramp up in production from Indonesia. And so were they able to do that just because maybe they have lower regulations or standards over there? It seems like it's doable if you put your mind to it, I guess, is my point.
Yep. The problem that I'm seeing with a lot of the nickel outside is it's very expensive to build. Like the projects that we have in Canada are huge, low grade. We're talking, $2-3 billion for some of these, and who's going to fund it? And none of these guys, you might get funding from the Canadian government, you might get funding, but that little bit of equity doesn't exist. And until the U.S. or some of these other guys come and say, we'll help you build it, I don't know how these projects get built. And the other problem that I've seen, there's a really good book that somebody put me on to called The War Below, about permitting in the U.S., and there was an interesting statement in there that the U.S. Biden administration is actually, very pro-critical minerals, green, energy, and blah, 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 electric vehicles. The problem is that they'll permit and fund processing, but they've gone out of their way not to fund mining because they have to satisfy another part of their party that doesn't want mining. And so it's an interesting, conundrum that they're living in right now. And then, people are wondering, well, what's going to go into that processing plant if you don't permit a mine? And so I don't know if they've thought this completely through.
Okay, perhaps not. Yeah, okay, that book that's on my reading list, so I got to push it up there. Okay, thank you for going through that. I think that helps me understand a lot. And so nickel market sucks. Okay, we've gone through that. There's other metals that are kind of not doing so hot, including lithium, which we spoke about this past summer. So maybe if we could look at other metals that you're seeing that are kind of in that situation, what is going on there?
Well, I think with lithium specifically, 90% down probably, but we got to understand the 45% drop in nickel and the 90% drop in lithium are coming from very high peaks. So we're coming down, but we're coming down off. You now have to be a lower quartile producer probably to make, decent money. But nickel's probably risk is technology. So the technology to produce and the technology in the battery. So one risk is the direct lithium extraction. So if people start being able to use that commercially, then potentially that'll put a lot of pressure on the spodumene stuff. That'll be higher cost and might not be viable. And if, the Exxons and the oil companies start, pumping out a lot of lithium from their brines like they're doing in southern eastern states and the Smackover, then that can put more lithium on the market. And if they start making newer batteries like the sodium, you don't need lithium anymore. And if Japan is not even using those lithium batteries, they're going straight into hydrogen. So that's the big deal for me in this critical mineral thing, is that technology is not constant. So if people have a risk in terms of a mineral commodity or something like that, technically they'll look for a way to put that thing outside of the product if they can't secure the supply chain.
Right, and on the technology angle, we were talking just before we turned the camera on about AI and how it can be used in mining. And I'm wondering if you can talk a little bit about that. It's so new, and I will say I'm an AI skeptic in many ways, but I can also see there are ways that it can improve.
Yeah, so I wrote like a little bit of a negative comment on AI because there's an AI Silicon Valley-based company that's doing mineral exploration called Cobalt. And they've been doing it for a while, and big land packages and stuff like that, but they need the data. So they're getting data and they're trying to find and trying to make, let's say, exploration more efficient. And because, just like in the retail market, people have no patience for exploration, which, could require 3 to 5 years. The next thing they do is they buy an old project for $150 million between upfront payment and exploration requirements in Zambia, which is a known deposit, and people have worked on it and walked away from it, and now at Indaba, they were calling it a discovery. So that does not paint AI favorably. So people who are skeptics would just say, no. But what I've seen is there are opportunities if you think about AI as a tool, if you refine it as a tool, and understand its limitations and always looking at it, it has useful applications.
Yeah, I think that's an interesting one that we'll have to see develop. So yeah, I guess you'll be watching that as well.
Yeah, I mean, the thing is, I'm already looking at bringing this into the letter potentially on using AI to model a potential resource tonnage and grade from drill intersections, and see what the probability of this grade or that tonnage, to see, on a high level, how big the thing could be. And if I could make that work with this guy who's developing it, that could be a great tool for people looking at investing in these companies where they only have intersections and there's no resource.
Right, and that's very interesting. So that does sound like it could be a great tool. And then I think the important thing to remember with AI, though, is you do need that additional context. Like you were mentioning with the Zambia, how people knew about this deposit and they know the other fact.
Yeah, exactly. But I mean, but they were supposed to come in saying we're using AI to do grassroots exploration. This is not a grassroots discovery. That's it. You can't say AI generated this.
Yeah, okay, really good to make that distinction, I think. Okay, so we've gone kind of some overarching things that we're looking at. And one thing I really wanted to bring up with you was this is an election year in the U.S., but it's also an election year in many other parts of the world. And I know you keep a pretty broad look at what things are going on. So for the mining industry, what should we be watching in terms of some of these elections?
Well, I mean, the U.S. election's obviously very big. And on the mining side, it's permitting. Like recently, resolution under the Biden administration, a court has basically rejected, the First Nations group, that didn't want the permit approved for them, to advance their project, and that was overturned. I think it probably can be, appealed again. Hopefully not. Then this project can finally get going. And it's a big deposit, the Resolution copper mine, and so that should be good. And so if we can see, and so people are waiting, like if the Trump administration comes in, do some of these projects that are sitting on the fence start getting permitted. So for some people, that's something that they're waiting for. And in other jurisdictions, like in Africa, and that the problem is that, even when you have an election, some people don't stick around for more than 18 months. And you can have the election, but that's going to change. And then in companies that, look for projects that are going to last 10 to 20 years, that uncertainty is not comforting. And it's not comforting for potentially the shareholders or the investors that are looking to invest in you. And so that's why nowadays, because all of exploration expenditures have gone down specifically for gold, less so critical minerals, people are putting more money in companies working in premier jurisdictions. So what I've noticed when exploration expenditures go out, then everybody gets funded. So suddenly all the high-risk places in Africa and Asia that start getting funded. But when all the money comes in, the Canadas, the U.S., the Australias get all the money. And everybody's left with like maybe 35% of their peak. So that's sort of what we're in right now.
Okay, and just to translate all of this information into something for investors, how are you strategizing in 2024? And again, keeping in mind, I know you're not looking necessarily for companies focused on commodities where the price is going to go up. You want to find companies that will be successful regardless. So what is your strategy looking like?
Well, right now, I mean, because even though you want to find something that doesn't need the price to go up 20% to be viable, you still need the price to be positive so you can get that sentiment behind so they can actually raise money. The problem is most of the things that we invest in are non-cash flowing, constantly have to go back to the market. So if the sentiment is there, they can fund and their cost of capital is lower. But if the sentiment is not there, then the cost of capital goes up a lot. And so what I've been doing to sort of mitigate that risk of higher cost of capital because of higher financing risk is I've been trying to, get out of companies that are in remote projects where the drilling costs are much higher, such that if they raise money, they'll have less of a drill program And, in grassroots exploration, the more you drill, the better. And so those guys are kind of restricted, and so I've tried to get more companies that are in places you could drill more year round and cheaper, so if you do find something, or, you have a better chance of finding it because you can drill more meters.
Okay, that's interesting. I really have no idea where it's easier or cheaper to drill. Anything you can...
Oh, yeah. I mean, what's weird is that, in Idaho, southern Idaho, and some parts of Nevada, even though we're talking the U.S., you can drive to the project. There's no helicopters. They're right now paying about $600 to $800 a meter all in. That is very high. And so I think it's part of its labor. I'm not quite sure why it spiked, but everyone's told me it's just gone through the roof. And I was just talking to somebody in BC that's drilling, in central BC, they can drive and everything like that, no camps. And they're paying maybe $250 US a meter, like nothing compared to these guys. So there's a bit of a, because I would have thought these guys would have been, so yeah, it's kind of weird. Yeah. But if you're in the Yukon, and you're remote, easily $1,000 a meter Canadian, so.
Okay, really interesting. I think that's all I was going to cover today, but did you have any thoughts that you want to leave investors with?
As I'm walking around, there's all this, like, getting back to critical minerals, like, that we had a lot of, because the last time we had an interview was, I think, at Boca, at Rick Rule's symposium, and one of the big companies that was getting talked about was Meteoric Resources, rare earth ionic clay in Brazil. And so as I've been digging into more rare earths, and this could be important for a lot of these critical minerals, is to know more about the individual markets, to know what they're actually producing, and to understand, what the end product is. Because there seems to be a big difference between the light and the heavy rare earths and what they present in terms of the battery and what the mine or the project has to produce. And so to understand that better might help you with better decisions in terms of which of these projects to pick if you're interested in things like rare earths. Yeah. Yeah, a lot more digging, and that's probably why people love gold and don't like this other stuff that's more complicated.
Yeah, I mean, there's gold is one, and there's 17 rare earths, so yeah. Okay. Yeah. Okay, well, maybe we'll come back and talk more about rare earths at a different time. But this was great. Thank you very much.
Thank you very much.
Of course. And once again, I'm Charlotte McLeod with investingnews.com, and this is Joe Mazumdar with Exploration Insights.